Assalamualaikum warahmatullah and warmest greetings to all. I am Madam Yusnaliza. Today we're going to discuss questions from MFRS116 equivalent to IAS 16. We'll be discussing a question from January 2018 final exam, question 1. So let's start. Okay, let us look at question 1a. You are asked to explain briefly decommissioning, dismantling and restoration costs related to the property, plant and equipment. So if you can still recall, decommissioning, dismantling and restoration costs are actually the costs that are included in the initial cost of the PPE, and we will include that at the present value, right? So those costs are costs that you are expected to incur at the end of the reporting period, or not reporting period, at the end of the useful life. You are also asked to state how the cost should be treated in the initial measurement. So how should you treat them or recognize them in the initial measurement of the PPE? So if you were to explain, you need to explain that they are the costs that are expected to be incurred at the end of the useful life. Let's say the useful life is 10 years, right? 10 years. So by the end of 10 years, so you are going to incur a cost, let's say to dismantle a gym equipment in a gymnasium itself. So that one is part of the cost that you will incur after 10 years, for example. So those costs should be included when you first buy the building. The cost to dismantle the equipment, the cost should be included at the end of the useful life. However, the obligation to bear the cost has existed, right, when the asset is acquired. So the cost will be incurred at the end of the useful life, but it has been somehow incurred, or it becomes your liability. A provision must be made on the date of acquisition or on the date where the construction is being completed. So that obligation existed. So you need to explain that the obligation exists when the asset is consumed. So when the obligation exists, it must be recognized at the fair value, present value. So the amount recognized will be at the present value, and the amount recognized will be included in the initial cost. So it will be included as part of the initial cost, where initial cost equal purchase price plus directly attributable cost plus initial estimate of dismantling, decommissioning and removal costs at the present value. If you have the future value, that future value is given to you, you need to discount that to the present, and that present value is what you included in the calculation of initial cost. Next, you have a company, Perfect Berhad, which is a local manufacturer of fitness equipment. So fitness equipment is not the PPE of the company, but this is actually the product of the company coming from its manufacturing process. It is marketed in Malaysia. They plan to expand the market in Sabah and Sarawak, and they need to have another factory. So to support that expansion, the company acquired a piece of land. So the company acquired a piece of land, and that land has an old building on top of it, and that is on 1st of January. 1st of January is on the date of acquisition of the land. So the date of acquisition is on 1st of January. Land is not depreciated, so the building that was situated on the land was demolished. So to demolish the building, there will be a demolition cost, and that demolition cost has to be added as part of the cost of the land. Why this is needed? This is needed because to enable the construction of a new factory. So the new factory is one asset, a new PPE. Land is also a PPE. So that one has to be included when you calculate initial cost. So the cost that relates to the project. So these are the details pertaining to acquisition of land. And if you read the question, you will see that you are required to identify the cost of the land and the cost of the new factory separately. So this is what we are going to do to be able to do that. First, acquisition of land. Acquisition of land, right? Land. This is to be classified under calculation of land. This will be capitalized and it will be added, right? Legal fees also under land, it will be capitalized and added to the initial cost. Demolition of the building that is to enable the new construction of the factory will be part of the initial cost of the land, and that also need to be capitalized and added. The land is not even, so it was to be incurring a cost of 50,000 to make it or to have level them, and that is also included in the capitalized and included. Direct material, so this one is related to the land. To the building. For the building, this direct material is 1.6, and this has to be under building. It has to be capitalized, so you have to add that. And architect fees 800,000. If you read at the bottom here, only 50% relates to the project, the construction of the new factory, right? Yep. And that 400,000 is the one that need to be included in the cost of the building, so add them. And the last one is directly attributable cost to be included in the building, 400,000 to be capitalized. So those are all to be added. None of them are revenue expenditure. Then you have the detail here where the 50% is for the construction of new factory and the remaining is for another project. The one for another project, that one will not be included, right? Next one, direct material also include excessive wastage. So this one, the wastage of material 200,000. This one must be deducted in the direct material here. So you need to deduct this item there, this item that I call A. So you need to minus A. And why? Because that you have purchased excessively. The contractor cost includes some rectification cost of 50,000. So that 50,000 also needs to be deducted from the contractor cost here. So the wastage will be deducted from the direct material. So that has to be deducted when you calculate the initial cost of the building. So here another deduction, here one deduction. Construction are completed on 31st of December. 31st of December. Wait, yeah. Okay, they are completed on 30th of December. So this is the date of completion of the new factory, completed. And factory was officiated, and they have incurred some officiating ceremony costs of 80,000. So this one has to be excluded from initial costs. So it has to be expense of to SOPL in the year incurred. So you need to record, and not to record under initial cost, but put them as the day-to-day or the costs that are not being recognized, but it will be part of the cost that will be expense of in the SOPL. At the end of the 5th year's useful life, the company is obligated to decommission, which is what you discussed earlier in part 1A, and that estimated amount at the end of the 5th year's useful life is 1 million. So this is the future cost. The present value, which is the price or the value today, the fair value today of the payment on the date of completion, right? So therefore the payment is at present value, and this is the one that you will include, this one, as part of calculation of initial cost. This one won't be included. Okay, let's look at what you have here. So whatever we have discussed, the cost, purchase price of the land. Should you have any discount, please deduct the discount. Import duties, should you have anything to do with purchase price item, please take into consideration. Demolition of the old building that is on the land itself. Cost of leveling the land to make it or prepare it for its intended condition. Direct material, right? So the cost for the land is 2.27 million. The direct material for the construction of factory must deduct the contractor excessive wastage. The contractor cost must deduct the rectification. Architect fees, you only show the 50% that relates to the construction of factories. Directly attributable costs, and the decommissioning costs, present value. Although this is the estimates, yeah, of the decommissioning, dismantling, and restoration. Okay, the total is 4.135 million. This is the cost that you will capitalize. Yeah, capitalize. That is the cost. Right, next. Go to the next part. Sorry. Next part is to do the journal entry to record the capitalization of land and new factory. So land, you know the initial cost. This is the initial cost, and credit bank or credit payable. So in one PPE that is non-depreciable, there's another one factory building that is depreciable for 4.135 million. But the amount that are considered as provision for decommissioning, which is in line with MFRS137, is 85,000. This is the one at the present value. So the remaining will be credited to the bank or payable, right? Next. Then you have the part C of the question. They acquired a building at a cost of 12.8 million. This is the cost of the building on 2nd of January. The policy of the company is to depreciate the building using straight line method over 50 years, and they apply revaluation model for subsequent measurement. So under revaluation model, of course, you know it will be fair. The revalued amount will be shown, and that will be at fair value less accumulated depreciation less accumulated impairment loss, subsequent accumulated depreciation, subsequent accumulated impairment loss. And you have the fair value on 31st of December of the building was to be 22.4. So you are to adopt the revaluation model. Under revaluation model, you will still provide depreciation after the revaluation has taken place. You will also test for impairment should there be any indication that the asset is being impaired. You are asked to determine the surplus or deficit on revaluation on 31st of December 2018. 31st of December 2018. Yeah, 31st of December. So remember, you acquire on 1st of January 2013. And now is 31st of December. This is the date that you have your revaluation model adopted, right? And that was after 14, 15, so after 4 years. 1, 2, 3, 4. So after 4 years. So this is the date you acquire the building. You have to determine that on 31st of December. So what you need to do is first to determine what are the carrying amount on 31st of December 16. Then determine what is the fair value that was given in this question. Then see whether fair value more than the carrying amount or fair value less than carrying amount. So this will give rise to surplus. This will give rise to deficit. After you have found out the deficit or surplus, you will need to prepare the journal entry. Yeah, journal entry to record only the surplus. So you're not required to record all. So the first step is to identify, of course, the carrying amount. To be able to identify the carrying amount, you need to first identify what is the cost. So the cost is, in case you need to calculate, so this one is given in case you need to calculate, you need to finalize the cost, 12.8 million. Then you need to calculate the accumulated depreciation, yeah, of the building for the 4 years that you have acquired, but right before the revaluation date for the 4 years. So if you've done that, you take the cost. Cost here is cost minus residual value if there is any. 50 years is the estimated useful life. 4 years is the year that you have acquired. The year that you have acquired is the one here. Yeah, the one here. Then you get 1024. For your information, 1024 is the depreciation for 4 years. For 4 years. For 4 years. And then you need to understand that in that year there is a depreciation. as well as you need to also understand every year there is an annual depreciation. But we are not considering the annual depreciation at the moment. We are just looking at the accumulated depreciation. Right? So we are focusing on this. Then you have your carrying amount on the revaluation date. 11.776 million. You will compare them with the fair value on the same date. 22.4, this is given. So the difference is 10.624 million, where the fair value exceeded the carrying amount. So because of that, you have a surplus. So this is initial revaluation. What is initial revaluation? Revaluation that took place the first time. Should you exercise revaluation in the future, that is called subsequent revaluation. So you're not asked to do any journal entries for the first 3 items. You are just asked to do journal entry for this one, which is your revaluation surplus. But let me remind you that this 22.4 million is the value, which is the fair value that you will show in your soft P as at 31st of December 16. You will no longer show the costs because it has been revalued. Next. So this is a journal entry for the revaluation surplus. Yeah, the revaluation surplus. And ARR that you credited here is not simply any ARR, but it's the one related to the building. That particular building, maybe building A, building B. You cannot simply mix up building A and building B together in terms of revaluation surplus. It has to be treated separately. So when you credit ARR, that will also be reflected in the other comprehensive income in the SOPL. So you must make sure you include that, and also in the statement of changes in equity, where you have the heading of ARR. So that one has been done in FAR210, your previous study. Next, this is question 1D. Question 1D is about Top Berhad. They produce diving equipment. That is the product from them, and the company acquired a machinery. So the machinery was acquired on 1st of January 2013. 1st of January 2013. Right. And then you have the cost of that is 500,000. So we're focusing on the PPE. Machinery is used in production of diving equipment. So diving equipment is not the PPE, it's the machinery. It is depreciated over 10 years. 10 years is the estimated useful life. It used straight line method. At the end of the useful life, there is a scrap value. Remember when you learned before, for the straight line method, the depreciation is based on cost. But cost here refers to depreciable costs. Depreciable cost is cost minus residual value. Another name for residual value is scrap value. So you need to find out what is the depreciable cost, which is 500,000 minus 35,000. Then only that figure will be subjected for depreciation. 1st of January 2015, the machinery broke down. So the machinery broke down and required an overhaul. So there is a cost incurred. The overhaul cost incurred was 11.5, and that happened after 2 years you have been using the machine, which is on 1st of January 2015. And that overhaul cost will just maintain the normal production of the machinery. So it's just your expenditure that you incurred that will not enhance the future economic benefits or the value of the machinery, but it's just to maintain the working condition so that it is working in accordance with what you have expected in its proper working condition. So this one has to be expense off, and this is subsequent costs. This is a subsequent cost, but this subsequent cost does not qualify to be capitalized, but you must expense off to the SOPL in 2015. Then next year, which is on 31st of September 15, there was a change in the weather. So there was some weather, climate change maybe, so changing the weather. It adversely affected the sales of the diving equipment. So people no longer want to go for diving. So the sale of equipment has somehow dropped. And that was because of the change in the weather. Yeah, like in the case of COVID-19 now, that also has caused a lot of drop in sales of a lot of products. So that might be a case of impairment. So here is an impairment indicator where you're informed that the sales of the diving equipment were adversely affected. At the end of the year, 31st of December 2015, the fair value of that machinery was 300,000. The fair value. The cost to sell, remember, fair value less cost to sell. So fair value less cost to sell is this figure given, which is 300 minus 5,000. Yeah. The value in use, VIU, value in use is 250,000. This one is 295, right? So you will see that there is an indicator that there is going to be an impairment. We'll see that later. However, the recoverable amount, if you can see, it's going to be 295 because you are asked to later talk about the impairment. Discuss accounting treatment for the overhaul cost. Remember, overhaul cost is the subsequent expenditure that does not improve the value of the so-called machine. Right? It's just incurred to maintain its existing working condition. So let's look at the accounting treatment for overhaul costs. So that does not increase. That does not increase the production capacity. Nothing is increased. None of the diving equipment can be produced more than expected. So just to maintain. Therefore, that has to be expense off in the year incurred as at 31st of December 2015 financial statement. That will be put in your SOPL as part of your admin expenses because it is just to maintain the normal production. However, if it's vice versa, it will be able to extend further the useful life, or maybe extending the capacity, improving the number of services, improving the product, or maybe reducing the cost significantly. That can be included as part of the cost of the machine. We go to the next one. Okay, we are asked to comment whether the impairment test for the machinery should be conducted on 31st December. So this one relates to the question part D earlier. I mentioned to you that the diving equipment has some kind of drop in sales that was claimed to be as a result of the change in weather. So that is an indicator that impairment tests should have been conducted. Like in the case of COVID-19, a lot of impairment tests has been conducted to reflect the assets of the company more realistically. Okay, so it should be conducted on 31st of December. This is because there is an indication that the asset may be impaired. What was the indication? It is the sales of the diving equipment that were adversely affected. Right? If the sales are not affected, maybe you don't need the impairment test. And that was due to the change of weather, sometimes due to flood, sometimes due to maybe damage of your building, that will also affect your sales. Next. So you are asked to calculate the impairment loss. If you were to calculate the impairment loss, first is to calculate the carrying amount. Second is to calculate what is the recoverable amount. Third is to calculate and what are the difference between the two figures. So first do this carrying amount. So to calculate the carrying amount, number one, so take the cost minus accumulated depreciation. So as I said earlier, cost minus residual value divided by 10 times 4, 10 times 4 because the impairment test took place on 31st of December 16. So after 4 years. So you have the depreciation for 4 years, 186. That will give you 314. So that is the carrying amount. Now you will calculate the recoverable amount. So to find recoverable amount, you need to see whether you are given value in use or you are given fair value less cost to sell. In this question, you are given both. So if you are given both, you need to compare those two values, value in use with the fair value less cost to sell. Okay, here fair value less cost to sell, we have already calculated to be 295. Value in use is 250. So you will see which of the two is higher. The fair value less cost to sell is higher. So this one will not be incorporated. So you will compare this item here with the carrying amount. So if you do that comparison, you will see 19,000. This will be your impairment. And since you are not informed whether the company use the revaluation model, you need to check that. If it is using revaluation model, you have to follow the treatment under revaluation model, right? However, if you do not use revaluation model, that means that is because the company use cost model. So in this question, nothing is stated, we assume cost model. So this has to be expense of in SOPL. This is what you call impairment loss, right? So this is the presentation as required by question 1E in the SOPL. Depreciation 25,000, yeah. That is the depreciation of the equipment. You are asked to construct the SOPL. And this is nothing to do with what we discussed earlier, but this is something to do with the equipment itself, right? For question 1E, equipment. Where you purchase, the detail is here. Let me show you the detail. So the balance of the equipment as at 1st July, go and check your question. You will see that in that question, the cost of the equipment, there was an equipment. You go and check your 1E. Yeah? I'm just trying to put away the straight away the answer. And then the accumulated depreciation in that question, 5 years is the estimated useful life. So you have to take 125 divided by 5. So per year, this one is the depreciation. Also the accumulated depreciation because it's the only for the current year. So that one is working one. And then the impairment loss were given in that question. In that part E, the impairment is given straight away in that sentences in the paragraph. So you just take that. So before this, you say carrying amount is cost minus accumulated depreciation. But with the impairment loss, carrying amount is now cost minus accumulated depreciation minus accumulated impairment loss. So the carrying amount here is based on cost minus accumulated depreciation minus accumulated impairment loss. So this 70,000. So that will be compared with the disposal proceed as were given in that question to be 50,000. Disposal proceed is when you sell the asset, the equipment, and you get the proceed from your buyer. That is what you call disposal proceed. And you will compare that proceed given by the buyer with the value or the carrying amount of your equipment. You see that now you sell at 50,000, the asset is at 70,000, so there is a loss of 20,000. So this loss is to be expensed off again. And in this year, no depreciation is being charged in 2016. Why? Because following yearly basis, no depreciation would be charged. If it's monthly basis, you still provide depreciation up till the date of disposal, meaning that for the month of August, September, you need to provide depreciation. Right. That's it. I thank you for watching. I hope that this helps you with the question doing of this topic. And I'll see you and I will see you. Assalamu alaikum wa rahmatullah.